Welcome to Kaizen Time, part of the Blood, Sweat, and Business podcast, where we provide constant improvement to businesses through timely, actionable financial solutions. Do you want answers to your financial questions? Email us at bsp@kaizencpas.com. I'm your host, Mark Valesky. Now let's get started. Welcome to another episode of Kaizen Time. I'm joined by Eric Jorn, a partner here at the firm. Eric, how'd you get here?
I drove a vehicle.
Yeah? Was it a business vehicle?
It was.
Okay. And is there some tax savings that is involved with having a business vehicle?
There sure is, assuming that you buy the right one.
There's a right one?
There are right ones, and there are ones that are maybe less beneficial.
So probably like a motorcycle can't really...
That can work. That can work.
Is if you were like a daredevil?
Well, I mean, assuming that you have a business need and it satisfies the business need, theoretically you could do a motorcycle, but we can talk about some more practical uses.
So I getting a feeling that the more you can use it for your business use, the more applicable it could be for a tax write-off.
Absolutely.
Okay.
Right.
Okay, that makes sense.
Yep.
So then let's get into that. How can you kind of maximize your tax savings then?
Yeah, here's an interesting anecdote. So we had a client, and they were looking at buying a new Porsche, about a $300,000 Porsche, and they wanted to do it for year end to get the tax savings. He said he talked to his friends, and he said, "Hey, you should buy a vehicle for your business. You could write the whole thing off." He's like, "Well, I'm going to I had a lot of profit, fantastic year. I'm going to go buy this Porsche."
Okay.
So he calls us up and said, "Hey, I'm thinking about buying this car."
I feel like you guys are glad that he called you.
Yeah, a little bit.
As opposed to, "Hey, I got this Porsche."
A little bit. So, we had this conversation, and we could have went down the route of, hey, is this really a practical business vehicle? Is it reasonable, ordinary, and necessary for the operations of my business? Does it meet some of the compliance guidelines for buying a vehicle for your business? But sure, we can make an argument one way or the other, and you can talk about, whether or not it fits, the purpose and all that. But we went and we said, hey, from a practical standpoint, there's not a lot of tax benefit to buying a $300,000 vehicle. And he said, why? And we said, well, that Porsche falls under what's called luxury vehicle depreciation caps. So what is that? So when you buy a smaller vehicle, largely geared towards sport cars, but it's really anything that's not like a big heavy truck, van, or
it's not a work
SUV
vehicle, I guess
exactly.
Is what you'd say.
Yep. They're going to limit your depreciation deduction to $20,000 per year, roughly. There's specific numbers in that, but let's just use that as our talking point. So that Porsche, to get all the tax benefit out of it, $300,000 Porsche, $20,000 a year. That's about 15 years right off on that Porsche.
And you're probably not going to be driving it for 15 years.
Yeah. So you're going to outlay $300,000 in cash to get $20,000 a year deduction. That sounds like a really poor investment.
Okay.
And that was the right conversation to have, because that obviously that garners the ROI as a poor. That's a very poor decision from an ROI standpoint, not from a compliance. I mean, the compliance had a lot of red tape around it, right? Trying to justify that type of vehicle as a business deductible vehicle. So that's why you see, so the IRS, to kind of create some tangible measurements around what's a more fit business vehicle versus a less fit business vehicle. They threw out some guidelines around the vehicle attributes.
Okay.
So obviously one of them are small vehicles, lightweight vehicles, like small SUVs, small trucks. They all fall under a category called luxury automotives. They have very limited depreciation ability. So meaning, you get, say, a $20,000 a year write-off on that vehicle maximum. Obviously, if you bought a $30,000 vehicle, you can get $20,000 the first year, $10,000 the second year. So they're trying to avoid buying a luxury vehicle like that. So you'll hear out in social media land, very popular luxury vehicle to buy is Mercedes, the G-Wagons, because
don't people like live in those things and travel across the world?
you could do that. I mean, it's like it kind of looks like a Jeep Wrangler in a way, except it's got a Mercedes badge on it.
Yeah, they're like a little bit bigger too, right?
Yeah, and they might cost $150,000 to $200,000.
Okay.
So those fall under a category of vehicle called a heavy SUV. So the IRS says if the vehicle weighs over 6,000 pounds, it's considered a heavy SUV. It's got special depreciation attributes to it. So we can use what's called Section 179 depreciation on about 30,000 of it. And then the rest of it's subject to bonus depreciation. Bonus depreciation a few years back, we could take 100%. They've started to kick it down from 100 to 80 to 60 to 40 to 20, and eventually will be 0% for bonus depreciation. They're trying to phase that out, go away. But it was very popular at that point in time when we could essentially write off that whole entire vehicle at once because it fell into that attribute of being a heavy SUV. Way back in the day, it was the Hummer. Mm-hmm. The Hummer was a very popular business vehicle. You saw a ton of business owners driving around in them because they were greater than 6,000 pounds, even though it's not really a practical vehicle. But what they're saying is like, maybe you need a bigger SUV to haul around things.
Even though you may not be doing it.
That was some wrinkle. Maybe they were just trying to incent people to go out and buy these big old SUVs. But that was one class that still exists. It still has a pretty good benefit. It's obviously gone down now, but that exists. So heavy SUV, that's one of them. Next is going to be like a heavy truck. So the nuance on this is if you're going to buy a pickup truck, it needs 6 feet of open space cargo. So effectively that's your truck bed.
I was about to say, so it has to be at least 6 feet in the bed.
Correct. So one thing you'll see if you go out and you look at pickup trucks, you will have two types of pickup trucks. You'll have short bed or standard beds, which are generally 5.5 feet to or less. Mm-hmm. Or then you'll have full size beds, extended beds, whatever it may be. That'll be maybe 6 to 8 feet.
Okay.
So there's definitely a clear distinction of which way you go when you go buy a truck. Now, a truck that has a 6 foot or greater bed is actually eligible for full Section 179 depreciation, meaning we can write off the whole balance of that pickup truck because they said people don't buy 8-foot bed trucks for fun, right? It's not very, especially
that's very fair.
I mean, I don't know if you've seen a double cab 8-foot bed truck ever parked somewhere. It doesn't fit in parking spaces very well. You're probably not buying that for the joy and pleasure of driving that big old truck around. You're probably buying it for work purposes.
You're definitely not enjoying the pleasure of parking in the parking lot. Yes.
Correct. So now you got to think about something like, hey, you see those Sprinter vans.
Sprinter van.
Like a Sprinter van, like those cargo vans. Maybe sometimes people, the big old white ugly vans. They look like cargo vans, or I think Ford's got one. Ford or Mercedes, they all have them.
Okay.
They're cargo vans effectively. So they don't have a bed, right? Or they're probably not 6,000 pounds or heavier because they're meant to be efficient for transporting things. But when you open up the back, there is all this flat open space, not a bunch of seating or anything like that, but just flat open space for cargo.
Okay.
So that actually meets the criteria of, hey, I got 6 foot or greater of open cargo space.
Are those the key ones then?
Those are going to be your key vehicles to buy.
Okay. So let's get back to the conversation about the motorcycle then.
Yeah.
Just to really touch base. What if you do really use it? You live somewhere where you don't get snow and miserable weather for half the year.
Yeah.
You can, take that around to work. Maybe you even transport some stuff on it, just on the back or whatever.
Correct. Maybe you have a delivery business of some sort and that gets significantly better. Maybe you're delivering, maybe you're a process server. Here you go. Okay. Right. And you're an independent contractor, process server, small business. Mm-hmm. And you provide motorcycles, mopeds, whatever it may be, qualified business expense. Now they might not be subject to the same, right? We don't have 6 foot or greater cargo spaces. I can't think of a motorcycle that weighs more than 6,000 pounds.
I doubt it. Yeah, right.
So obviously if you go out and you buy, what is the Harley's got the Road King, that might be a $40,000 motorcycle by now. That's going to be probably pretty limited. What about just about every other motorcycle would fit under some type of depreciation limits?
So essentially what we talked about is, the weight class and the cargo storage. Those are kind of the added perks that people could look for when purchasing a work vehicle.
The vehicle characteristics. Exactly.
And
right.
The other thing is really just how much it's really being used for work that you would be able to write off.
Exactly. So obviously when they talk about 100% write-off, that's assuming it's 100% used for business. Obviously, if you have a mixed use for it, right, you have a couple ways of addressing that. Either you can reduce the amount of depreciation you take, or you take what's called a fringe benefit on your W-2 for personal use of a business vehicle. So either method works. It's a matter of substantiating what is the actual personal use of that business asset. Couple other nuances around buying vehicles. Big question we get all the time is, hey, if I go and I finance a vehicle, does that change anything? As in, I'm going to go and I'm going to buy the vehicle and I'll pull out a loan from the whatever bank or credit provider for that vehicle. That is like buying it cash. So you get full access to all the depreciation, even if you go and you take a loan out to buy the vehicle.
That's a beautiful thing to know.
It is. Now, if you have a leases work differently. Lease, you would expense the payments as they're incurred. But now, say you wanted to go buy a luxury auto. Now you're looking at two different things, right? If I go and buy, maybe I don't know these numbers. We don't generally deal with them all that often because our small business owners, we coach them to be fiscally responsible. But say I go and find a lease for $4,000 a month on whatever luxury, whatever I'm buying. You would actually expense those payments, even though that'd be $48,000 a year, when normally luxury auto is limited to $20,000 in depreciation for the first year. So there's cases where luxury autos and leases play in the marketplace above and beyond some value retention and criteria about buying versus leasing a luxury auto. There's a tax play there as well.
So basically, before you go buy a vehicle, call your accountant. That's the best thing they could probably do.
Sometimes it's really funny. I've had many of phone call conversations of somebody sitting in the finance office chair buying a vehicle, asking me questions about, we'll talk about a couple other little things, right? Mm-hmm. Who's the loan name in? Who's the vehicle titled in? Who's it insured through, right? If you want it to be a business vehicle and a business asset, it should have those three things, right? Otherwise, it's going to look like a personal vehicle, in which you have a personal vehicle that you use for a business, especially an S Corp.
Doesn't work the same.
Now you're just subject to mileage reimbursement, meaning I need to track my business use and request submit for reimbursement.
And is it different from an LLC? LLC, there's a lot more.
There's a little bit more
leniency, I'd say.
Yep. Yeah. So LLCs, depending on the business, the tax structure, you don't necessarily have to do a reimbursement because you're not an employee of a partnership or a sole proprietorship. So you can just take a general mileage deduction at that point, but as through an S corporation, since you are an employee of it, to get that deduction, you actually have to reimburse you for the mileage that you submitted under your company's written policy. So that goes even into further depth of, do you have an accountable plan in place to get reimbursements for personally incurred expenses?
All right. Well, with that said, let's wrap this up. Anything else you want to add for maximizing your tax saving?
Yeah, no, I think you hit it on the head. Just, when you're thinking about buying a vehicle, right? And I don't say don't go buy a vehicle just for the tax savings, but let's have a call about it. Let's make sure we set you up for success and maximizing whatever you need to buy for your business.
Perfect. Thank you, Eric.
Thank you.
You've been listening to Kaizen Time, part of the Blood, Sweat, and Business podcast. If you like what you heard, subscribe and leave a 5-star review. This podcast has been brought to you by Kaizen CPAs Plus Advisors, providing advisory and accounting services to help you grow your business. Learn more at kaizencpas.com or email us at bsb@kaizencpas.com.